Question 31. In this question, we need to answer two questions. So before we go to the questions, let's first prepare the allocation schedule of the acquisition day subsidiary fair value. Okay, so this is the schedule I prepared, and start with the fair value of the controlling interest. So parent obtained 60% of controlling interest, and the fair value of that controlling interest is 372,000. And the fair value of the 40% non-controlling interest is 248,000. In total, it is 620,000. And as to the book value acquired, the total book value acquired is 320,000. It equals to 100,000 common stock plus 220,000 retained earnings. And next we use total fair value minus book value. We'll get 300,000 excess amount. And next we need to allocate this excess amount to those accounts with different fair value from book value. The first account is patent. Patent is undervalued by 70,000. It has a 10-year remaining life, so which means that every year there is a 7,000 excess amortization. And the second one is the customer list. It's not recorded on the book, but it has 45,000 market value, which means that undervalued by this amount. It has 15-year life, and which means that every year there is going to be 3,000 excess annual amortization. Okay, and then next we are going to allocate the remaining amount to goodwill. So the goodwill equals to the total excess amount and minus 70,000 allocated to patent and minus 45,000 allocated to customer list, and we have 185,000 left. And that's going to be the goodwill, and we do not normally we do not amortize goodwill. So the total excess annual amortization would be 10,000. That equals to 7,000 plus 3,000. Okay, and then let's come back to see have the question. Question A: show how McRoy determined 411,000 investment in Stinson account balance, and assume that McRoy defer 100% of downstream intra-entity profit against its share of Stinson's income. Okay, so in this question there is the intra-entity transfer, which is downstream. Specifically, is that every year the parent sell inventory to the subsidiary. So this is the intra-entity transfer. It's a downstream transfer, and because of this remaining unsold inventory at the end of each year, so there is a deferred gross profit we have to adjust. Okay, and then this 100% of downstream intra-entity profit against is going to be deducted from its investment income. That's what question A means. Okay, so let's come back to my solutions about how we solve this question A. In order to solve question A, because we need to defer 100% of this downstream intra-entity profit, so which means that we need to have those intra-entity consolidation entries prepared. Alright, so first let's prepare the consolidation entries related to the intra-entity inventory transfer. So because this is 2018's entry, so first let's prepare the entry strategy. This is related to the prior period deferred profit, so we need to recognize those deferred profit from in the inventory that's returned in last year. Okay, and then in that journal entry, we debit investment in subsidiary and credit cost of goods sold, and the amount equals to the remaining inventory at the end of last year and times the gross profit margin, 20%. So how I get 20%? 20% equals to the selling price minus cost and divided by the total selling price, and got 20%. And second entry is entry TI. To eliminate intra-entity sales amount, debit sales, credit cost of goods sold, 160,000, and 160,000 is the total sales, intra-entity inventory sales in 2018. And then last one, the entry G, this is what we're looking for, is the entry to defer the intra-entity, defer the gross profit that's stuck in the inventory that's not sold. And the amount equals to the amount of the remaining inventory and times the gross profit margin of those inventory, and it equals to the total sales minus the cost of the inventory and divided by the sales, and we got 30%. And the amount here is 12,000, and this is the amount that we have to deduct, that we're going to defer this total profit against its share of the Stinson's income or investment income. Okay, so let's come back to this this formula about how we get the investment in subsidiaries balance, the investment account balance. So generally speaking, this investment account balance equals to its beginning balance and plus the income from the subsidiary company minus dividend from the subsidiary company, and then also remember to minus this those excess annual amortization. If it's 2 years, then it will be 2-year total amortization. And here in this question, we have one more thing, is we have to deduct this deferred gross profit in 2018. That's the cost of goods sold amount in entry G. And one more thing we need to pay attention is that because the parent company only have 60% of the controlling interest, which means that we have to put all the numbers around here. We have to times 60%. Oh, sorry, not all of them. Okay, this amount over here. Okay, that's 60%. The reason that we keep this 12,000 out is because the question told us that we will defer 100% of downstream intra-entity profit against this share of Instinct income. Okay, so 100% of that 12,000 will be deducted from investment income. All right, so then let's come back to this equation. The question already gives us the 2018 Brace net income. So we have this number, which is 60,000. We know 2018 Brace dividend, 15,000. And also we know the excess annual amortization, which is $10,000 per year, 2 years, will be 20,000. The question is, what is the number related to this 2017 Brace net income and the dividend? So we can solve it with the Brace return earnings. Remember that the equation for return earnings, that the ending return earnings equals to beginning return earnings plus net income minus dividend. So I just reorganized that equation, and we can calculate this net income minus dividend equals to annual return earnings and minus beginning return earnings. Both numbers are given. We know that at beginning of 2018, and the total return the balance of return earnings of the subsidiary company is 280, and then at beginning of 2017, its return earnings 220. So $60,000 is the change of the return earnings in 2017. So which means that the net income minus dividend equals to 60,000. So even though we do not know Brace net income in 2017, we do not know Brace dividend in 2017, but we know that Brace net income minus Brace dividend equals to 60,000. So that's enough for us to get this amount together. Okay, so if we get these two numbers solved, then we can get annual balance of the investment account is going to be 411,000. It equals to the beginning balance and plus the changes within these 2 years. Alright, I'm going to use this video to prepare other consolidation entries. The first is entry S. We use entry S to eliminate subsidiaries' equity account balance. We have two. One is common stock. Its current balance is 100,000. The second one is retained earnings. Its beginning balance is 280,000. And both numbers has been provided here in this financial statement. So common stock 100,000, beginning retained earnings 280,000. So I'm going to eliminate these two balance. And credit investment in subsidiary and also credit non-controlling interest, we're going to allocate 60% of total debit to investment account and 40% of the total debit to non-controlling interest balance. Okay, so second entry is entry A. Entry A is to adjust for those fair value allocation amount, and we have three accounts here. One is patent, the other one is customer list, and last one is goodwill. And for patent and customer list, their current amount we input into the entry is original allocation and minus 1 year amortization, because this is the beginning of 2018. So after 1 year amortization, a new amount for patent is 63,000 and for customer list is 42,000. Because we do not amortize goodwill, it's still going to be 185,000. And then debit. So we debit investment account and also debit non-controlling interest account. We're going to allocate 60% of total debit to investment account and then 40% of the total debit to non-controlling interest account. Next entry is entry I. Entry I is to eliminate the intra-entity investment income from the subsidiary. So we debit income from subsidiary and credit investment in subsidiary 28,000. This number is also given by the question already. Okay, it's here. So the equity earning in Stinson is 28,000. So the number is given directly. Okay, so that we have 28,000 here. And next one is entry D. We use entry D to eliminate the intra-entity dividend payment. So debit investment in subsidiary and credit dividend from the subsidiary. And the amount is 60% of the total dividend paid, which is 9,000. And the last entry is entry E. So we use entry E to recognize this excess annual amortization expense, which is 10,000, including 7,000 for patent and 3,000 for customer list.